Hi again, welcome to the Presidio Group's Drive-In Live series. I'm Jason Stein, Managing Director at Presidio, and I'm joined again today by my partner here, Kevin Tynan, our Director of Research. Hi, Kevin.
Hello, my friend.
We're once again very happy to spend the next 30 minutes in front of an audience filled with senior leaders, decision makers, and executives from across the automotive space. As always, we're excited to again provide a unique perspective on the earliest release of dealership operating data in the auto industry, delivered through Presidio's exclusive partnership with NCM Associates and representing more than 4,000 dealers across the U.S. Now, that partnership gives us what we believe is the most robust, timely, and comprehensive read on dealership performance anywhere in the market. More importantly, it gives us something beyond just data. It gives us early signals and a view into how this industry is actually performing right now. And how is it performing? Well, here's the quick takeaway. Dealer profitability declined again in Q2, but at almost the same pace as Q1, which is the first real sign this earnings reset may be stabilizing rather than deepening. New and used vehicle margins remain well below year-ago levels, but both improved sequentially from Q1, and so did F&I. Fixed operations, which had appeared to be slowing in Q1, re-accelerated sharply in Q2, though nearly all of that lift came in June alone. And segment performance continues to diverge. Domestic dealers were essentially flat on profit, while luxury absorbed by far the steepest decline. Q2 is lapping one of the toughest comparisons of this cycle, a quarter last year that was inflated by tariff-related pull-forward buying and unusually strong vehicle margins. Lots to discuss here, Kevin. We're going to spend the first 15 minutes on data and our own perspective. Then we're going to move to your questions for the final 15. You can submit questions at any time by clicking on the Engage button at the top right of your screen. And as always, you can access our full reports at our brand new website, thepresidiogroup.com. So with that, Kevin, let's go back to the big picture. Let's start with dealership profitability. Q2 net profit declined 11.8% year over year, essentially in line with Q1's 11.2% decline. Again, against a Q2 2025, you might remember, 27.1% profit gain. That, of course, was the tariff pull ahead that I mentioned earlier, and an easy comp to 2024 CDK outage that disrupted the quarter. So let me ask the question, is back-to-back quarters of nearly identical year-over-year decline a sign that dealer earnings are stabilizing?
In the big picture, yes, right? We'd like to see a little bit more stabilization within the makeup of those earnings. So new and used vehicle, per vehicle gross, right? Like to see a little bit of a floor come in there. It's lower than it was a year ago, sequentially a little bit better, some stabilization there. But really what's driving it is the finance and insurance component, the F&I side of things, fixed ops, good quarter. So the big picture looks like stabilization. Would like to see a little bit more come in on the big revenue business units being new and used.
So let's talk about new then,
Okay.
and we'll go a layer deeper on the vehicle side there. New vehicle unit sales were essentially flat overall, down just 0.2%, but that masks a real divergence underneath, right? So domestic down 4.5%, luxury down 3.5%, and import once again the lone volume gainer up 5.3%. What are you seeing there?
Yeah, and again, you talked about the year-ago quarter, and that was a little bit messy or noisy with the tariff pull ahead, especially for the luxury brands. And that was an interesting quarter, second quarter of 25, because it wasn't, and we've talked about this before, this wasn't about price or margin. It was about getting deals done from the consumer's perspective before prices went up significantly. So noisy quarter there, not overly concerned about any particular segment with fundamental weakness throughout the second half of the year. I think some of that pent-up demand gets released as we go through next quarter. Comps are easier, so I think everything will be okay there. More interested in the price and margin dynamics of those segments.
Frankly, a lot of noise in the number of quarters that we've sat here and talked about this. And let's talk about how gross profit's been affected.
Right.
Gross profit per new vehicle retailed fell 13.5% year over year, but sequentially now actually up 3.3%. So what are you seeing? How do you interpret what's going on there?
That's where you'd like to see that floor come in. And
Right.
Again,
stabilization.
The year ago quarter was not about pricing, right? It wasn't about volume. It was like, let's get this done. Because I talk about it all the time. Volume for volume's sake, right? Volume that you purchase as an automaker is not real demand, right? So you kind of have to strip out that noise and think about where is demand really. And I think at a 15.9 million through the first half of the year is a good place. I talk about 16 million being that break-even point where pricing and margin dynamics start to break down. Last year was a 16.3. At this point, we're a 15.9. I like the 15.9 better, right? As long as there's price stabilization there, which I think we're getting hints of or green shoots of right now.
Yeah, no, you mentioned SAR, so let's talk a little bit about that. June did a lot of the heavy lifting in this quarter. June alone ran at 16.5 million SAR. That's the strongest month since April of last year.
Right.
New vehicle volume and fixed ops gross both stepping up together, obviously. Worth noting, June of 2025 itself was suppressed by a hangover from that spring tariff pull ahead. J.D. Power estimated last year's roughly 15.3 million SAR would have been closer to 16. There's your number.
Right.
So part of this June strength is also a function of an easier comp, not just fresh demand. But how much of that is pent-up demand finally releasing versus a real durable shift in the market? How much is simply an easier comp? And what do we expect in July and August?
Yeah, July and August comps are easier because, again, we were dealing with that big. I mean, when you look at March, April, they were high 17 million last year. So that hangover was big, making the comps from this year easier. Again, I like being a little bit above where we were last year, which would probably be in the low 16 millions. It's a good place to be. I don't want to see 16.5s through the second half of the year. I think the price of that will be that price and margin dynamic we talk about. So I think we can surpass in July, August, September what we did in the year ago. Maybe not September. That was a little bit of pull forward because of the expiring EV tax credits.
EV credits.
But somewhere in that high 15, low 16 million, I think we're healthy going forward. And I think that's where, for the retail base, for the dealerships, where that stabilizing PVR comes in. And we can say, okay, we don't have to more than make up for declining per vehicle gross profit with F&I all the time, or with overall gross profit with fixed ops all the time, that we're actually getting some stabilization or a floor put in under the actual vehicle sales.
Used vehicles remain a more nuanced story. Used vehicle unit sales declined 2.7% overall, that's year over year. Domestic down 4.7%, luxury down 4.2%, import essentially flat, down just 0.6%. What are you seeing in used?
Yeah, and look, I think there's something there that's a component of higher gasoline prices, higher inflation overall. You're seeing the consumer push to the used vehicle market, and I think it's just a difficult space for this dealer segment, this retail base that says, we're basically the customer here in bidding for wholesale values, right? So on the new vehicle side, the vehicles are the same. And it's the consumer that drives pricing. Mm-hmm. In this case, it's dealer versus dealer. And that wholesale price is essentially, if you think of that as the retail price to the dealership, that's going up and up and up, right? So now your margin's compressing. And as a franchise full line dealer, you have all these other business units, all these other places to make money. And I feel like you get a little bit of distraction from the other business units to where you say, I'm not going to bang my head against this wall and fight wholesale values, CarMax, Carvana, trade-in values going higher and higher, compressing your own margin, and you see the group back out a little bit. And I think we're still getting a little bit of that. That was big last year and persists into this year.
Let's talk about F&I and fixed ops. F&I continues to be a stabilizer. This quarter, it was more than that. F&I income per retail unit rose 4.8% year over year to $1,769. That's the highest quarterly number we've recorded in the Presidio-NCM tracking history. Also up sequentially from Q1 $1,727. Much of that climb driven by higher average transaction prices, not just penetration or product mix. What else are you seeing there?
Yeah, and that's a really good point, is that, so going back to that used vehicle volume, right, there's your driver, is the F&I side of it. So you're saying, okay, margins compressing, volume down a little bit on the used vehicle side. I think that's where it's really important, is what it contributes on the F&I profitability side. So you're saying, and what I'm thinking about is, like, first let's get that floor under used and new PVRs, and then we can grow it with more F&I. But you need to be able to sell those used vehicles in the first place.
Right.
And I think what will separate the more successful dealers from those sort of bouncing along the average or the trend line will be that, right? Go in there, fight for the used vehicles because they're driving other parts of your business. And not just F&I, the fixed ops as well, right? You're creating a finance customer, warranty, off the menu, you're selling those products. You create a future service and parts customer going forward. So the value in growing that side of the business isn't necessarily in that front end deal. It's in what comes after, in the after sales.
Okay, now fixed. In Q1, fixed ops growth had slowed to just 1.4% overall. And this might be the most important reversal, right, when we look at the quarter. So in Q2, it did the opposite.
Yeah.
Fixed ops gross profit grew 5.2%, now represents 52.8% of total dealership gross profit, up from 50.1% a year ago. Again, almost all of that lift showed up in June. So was Q1 slowdown the anomaly? Was June the anomaly? Or is this actually a new run rate?
Yeah, somewhere in the middle, I would say.
Yeah.
But that's the business unit, right? That's the high growth. It can be higher volume. It's wide margin, right? That's the place where, if you're seeing growth and opportunity, that's the place where you want it to be, right? That's where the margin is. I think that's where the opportunity is. So that's a very good number. Maybe a little bit hot, going forward. I don't think that's necessarily as sustainable, but you also don't want to see that 1.4, or low one handle that we saw in the first quarter be the run rate either. Somewhere in the middle is probably healthy, and I think it's achievable. We talked about it almost every one of these calls. Larger fleet, older fleet, we're driving more. Miles traveled were down a little bit, just I think because of gasoline prices in the last month.
Right.
I think June out of the last 3 was the lowest, but it's marginal. But ultimately, the opportunity is there to drive traffic to your parts counters and service bays.
All right, Kevin, let's shift gears for a moment and talk about capital, because even as operating performance comes under pressure, the M&A conversation in this industry has not slowed down at all, as you know here. This morning, Car Dealership Guy released a new podcast episode featuring our president, George Corollas. And George discussed the current state of the dealership buy-sell market, where M&A is headed, and key insights from Presidio's recently released Q2 2026 Dealership M&A Market Update. The report is one of the 2 editions each year where, of course, we update the Presidio Valuation Index, including our latest Blue Sky multiple ranges. And this quarter also introduced a new Brand Watch section, highlighting the brands we're watching most closely. Here's the short version. The disconnect between operating pressure and deal activity is still very real. Buyers remain deep but increasingly selective. Strong appetite for high-quality assets, particularly luxury and top import brands in prime markets. And what basically George has said is a flight to quality. So when the right asset comes to market, buyers are still stepping up aggressively. But for anything outside of the top tier, scrutiny is rising. What is the M&A market seeing that the operating data isn't?
Yeah, look, it's the long view, right? So the deal market is thinking about the fundamentals of this business going forward. Much bigger picture, much longer view than just this quarter or the trailing 4 quarters, or even back into the pandemic, and understanding what the opportunity is there. You're going to have cyclical flights to quality. You're going to have a contrarian view. Very interesting space in that deals will happen for, I think that this market, the deal market, will never just be one dynamic. Complete flight to except in extreme circumstances, a 2009 bankruptcy period, a global financial crisis, things like that. But you're always going to have somebody contrarian looking to get in for something at the, buy low, sell high kind of mindset. You're always going to have somebody looking for the blue chips. You're going to have dealers aging out. You're going to have dealers aging in, right? So that those dynamics are always changing, and maybe the flight to quality is a little bit nuanced because of the broader macroeconomic or geopolitical landscape, but ultimately there's going to be deals ramp up, pull back, but it's always going to be there because of that long-term opportunity in this business, which is great profitability, great resilience, great versatility in earnings.
Excellent. With that, let's get to your questions now. So just hit that engage button at the top right of your screen to submit your questions here for Kevin. Let's start off with a general question. Are we nearing a point, Kevin, where total dealership earnings normalize closer to maybe those pre-pandemic levels? And if so, how much further to go is there?
No, I don't think we get back to pre-pandemic. The inventory levels aren't that high, and from the earnings perspective, high inventory is a bad thing, right? That's where we get forced volume above that 16 million just to clear the retail channel. That's where pricing breaks down, margins continue to compress. What we've seen where average inventory pre-pandemic would be close to 4 million units, we've really leveled off about 3 million units. And that's a significant turn. That one turn on inventory means a lot for earnings. So I would hope for stabilization, but not at those pre-pandemic levels. Certainly not at the peak of the pandemic either, when supply and demand were very tight, unsustainably tight. We're a little bit better than that and not quite as bad as the prior periods.
Very different stories, aren't they?
Yeah.
So let's go back to net profit by segment, where I think it told an even sharper story. Just a reminder, domestic was essentially flat, down just 0.2%, import down 5.6%, luxury down 13.3%, by far the hardest hit. That extends a trend that we first saw in Q1 when domestic was already the best performing segment. The gap has now widened even further, with domestic nearly erasing its year-over-year decline entirely. So what's allowing domestic to hold up so much better than luxury and import right now?
Well, you just have to think about where that tariff impact was going to hit the hardest in the second quarter of 2025, right? And you think about production facilities, factories here in the US, and how those are distributed, right? The premium brands, which are generally European, don't have a lot of capacity here, and that goes down the line. So their pull forward in the year ago quarter was the most intense. That means the payback in the year ahead quarter is the most significant. And likewise for the domestics, right? Like a lot of that production is here. The tariff impact looking ahead was not going to be as great. So now you get a much more level earnings comparison year over year. So I think it just runs right along the line of the way tariffs were going to hit in 2025.
Okay, let's talk about the consumer question here. With higher loan payments, inflation, and tariffs in play, how much of the affordability squeeze is landing on consumers, and how much are dealers and OEMs offsetting that?
Yeah, look, and this comes back to inventory levels for me again. And when you think about the 16.5 million seasonally adjusted rate we saw in June, there's a good amount of inventory sell down there. And as long as that supply-demand balance stays okay, which it is, I don't think we get runaway discounting or incentives. And in fact, I looked at the June average transaction price. It was actually up from May, a couple $100. It's up over $1,000 from the year ago. And so discounting is about that same $2,000 level. Prior to the pandemic, it'd be closer to $2,700, almost $3,000 per vehicle. And on the factory incentive side, we're running about 7% as an industry. That number would be double digits pre-pandemic. So and that all comes down to the inventory level.
All right, since you're talking about what's ahead, let's talk about what's ahead. Q3 2026 comps come with a different challenge. So they're obviously lapping last year's EV tax credit.
Right.
You've been clear that June's strength looks like pent-up demand releasing, not a new baseline. So you're not expecting July or August to keep pace. Given both those things, do you expect stabilization that we saw this quarter to hold through the back half of 2026? Or is there real downside risk once the June bump fades?
Yeah, look, and if that 16.5, like I said earlier, is a hot number, and I'd rather not see 16.5s for the rest of the year. I think that would come with pricing pressure, especially considering all those external factors that we're talking about: gas prices, interest rates, just inflation in general. And I think if you look in the third quarter, we got strong 16.1, 16.4, and as we go through the quarter, I don't feel like the industry needs to surpass those to look at it as a successful quarter. Keep us in that, high 15, 16 million unit range. Let's see, gentle increases in transaction prices, disciplined production that keeps inventory level. And I think the industry can kind of chug along at this rate and improve the earnings profile of the retailers at the same time through the second half of the year.
What worries you most heading into the second half?
That sort of challenge of the year ago, right? Again, 16.3 for the full year in 2025. The idea, and I don't think it's that much of a risk, that the manufacturers only see 2026 as successful if it's a better volume year than that, because I think the payback from that will be pricing power and margin going forward. And you got to remember too, when we start to talk about discounting and incentives, they're very addictive. Very difficult to reverse that. So as these things trend a little bit higher or inflate a little bit, it's hard to claw that back as you go forward. So you start piling on inventory and incentives go to 8% and discounting goes to 2,500. It's very difficult to get back from that. So the automakers, to their credit, have done a decent job of sort of holding the line on that, which is going to mean you're not going to get a runaway or a year-over-year gain in the total volume number. And I'm good with that. I would actually prefer that.
Okay, what we haven't talked about yet are the expenses. And on the expense side, personal expense increased 1.5% in the quarter, creeping up to 37.8% of gross profit from 37.2% a year ago. Advertising expense rose 2.8% and averaged $406 per vehicle in the quarter. Is that advertising number really a story about dealers spending more to reach the same customers? More competition for the same pool of buyers?
Yeah, and those are really interesting numbers. And why I like those numbers in this context of what we're doing is that I think, right, so those are going to be the averages. And I did these numbers for the publics for the full year of 2025. And their number as an average is in the low 300s, 315, something in that ballpark. But the gap was wide. There was sub 200, there was, 500 in there, and the average came out somewhere in between. But what I like about those numbers, I think it gives dealers the ability to look at them and say, where am I? And I think that when you do that, you're going to see where the average plays out, but that's just an average. And then you can say, where am I versus that number? And I think the more efficient dealers, I wouldn't necessarily say more successful dealers, will be somewhere more efficient than that. And those that are more in line or above that will say, like, hey, maybe that's somewhere I need to focus my expense cuts or consolidation going forward in the second half of the year and even into 27 and beyond.
Okay. Dealer question here. Should I be worried about customer pay trends, or will more vehicles, aging vehicles, plus recall volume mean I can keep growing that business?
Yeah, no, I wouldn't worry about it. I think there's going to be ways for every part of the value chain to create affordability going forward. And I like we talked about, there's a big pool of vehicles, there's demand for vehicles, there's inventory of vehicles. So, I'm not overly concerned about the consumer. I think generally over the decades I've been doing this is that when you get to this point of really being concerned about the consumer and the level of payments and the interest rate and the length of the term, we have bigger macroeconomic problems in a lot of cases, because you're talking about mortgages and rent and incomes, right? And it's this big picture thing. So I don't get too disturbed by the position of the consumer. I figure that there's a way to fight through and a lot of mechanisms, levers to pull to get the consumer where they need to be.
Okay. Ripped from the latest headlines, the news headlines, what do you make of the bid to take Penske Automotive Group private? What's the upside for Penske, and does it say anything about the future of public dealership groups?
Yeah, and look, we could do a half hour on just that question. It's a great question and super interesting in the middle of a sleepy summer.
Right.
No, I really, well, for Penske, look, not being public or being private versus being public is a big difference in terms of, being nimble and being able to do things that you necessarily can't do when you're a public facing and you have shareholders to answer to. But I think when you look at that and you think about all the places Mitsui Cannon does put money, that focus on the retail dealer space to me is very interesting. Now, Penske, largest market cap in the space of the public full line dealers, Europe, international business, trucking business. It's a really good place. I don't know that I'd go so far as to call it perhaps a watershed moment for public automotive retailers, but I think it's going to draw eyes to the sector and say, what is this smart money seeing in this space? And we see it every day, right? It's what we do. We see the value in the franchise dealer system, and it'll be interesting to see what Wall Street or private equity or smart money starts to see and realize that this is probably the most actionable part of the automotive ecosystem, more so than the manufacturers or suppliers. Like, this retail is the place to be.
It is the place to be, exactly. Question from a dealer on floor plan expense is down sharply, mostly because rates came down. How does that expense picture change if rates hold steady or even maybe tick back up, as has been hinted?
Yeah, I think the pressure to interest rates is to the upside.
Yeah.
And you look at gasoline prices, oil prices are inflating, and that's a component of what we see in inflation. So obviously, I would say that risk is that you'll get a little bit more of that floor plan expense come back in a little bit. I think, though, when you consider that part of it for the dealer group, right, but the turns of vehicle, right, the inventory turns are there. So, sort of the payment for turning inventory will make up for it a little bit, right? It's not this real slow turn, but I don't expect that we're going to get back to where floor plan is accretive to earnings.
Right.
It's still going to be a cost. It's going to be an expense going forward, and if anything, maybe a little bit more than it is now.
Question: how close are we to Chinese cars entering the market? There's a lot of talk, obviously, about what's happening north of the border. There's a lot of talk right now in Senate subcommittees on Chinese-related software, just even yesterday.
Yeah, the question is, are we close? I don't think so. It's a huge threat. I think it's on the industry's mind, but it's not a today or tomorrow problem. There's so much to be figured out, and that's the EV push. Is it an EV versus internal combustion push? Is it a question of China versus the U.S.? So I think that ultimately the way it plays out over time would be manufacturing facilities here, if it happens at all, U.S. workers, right? And then that cost structure changes significantly. But I think there's a lot of chapters to write before that's really a threat. And I don't think we're going to stand by and just say, export your vehicles to us, we're just going to start selling them here. I think there has to be a manufacturing component with it, and that's going to take time, aside from the legal, regulatory, political aspect of the whole situation.
Okay, final thing, 90 seconds to go. There are still structural tailwinds that support growth in parts and service. Very profitable business line for dealers. What's your view on aging vehicle fleet, miles driven, outstanding recall volume? Where should dealers be leaning in right now to protect and potentially grow profitability?
Yeah, and that's something we look at, the repair order count, especially on the customer pay being flat. And I'm saying, why isn't that growing faster? And as I think about it more, I'm wondering if it isn't a capacity issue. Right? So if you think about anecdotally, a customer calls and says, I need my vehicle in your dealership to do this, that, the other thing, right? Larger fleet, older, but you got 2 weeks, 3 weeks before you can get an appointment. Well, I'll go look somewhere else. Maybe it's an independent, maybe it's another dealer, however that works. So I'm thinking, like, this isn't just lower your rate and get more business. This may be build out some capacity, right, in terms of the number of bays you have, mobile service, things like that, to be able to service more customers in that way.
Wonderful. Kevin, thank you so much. Thanks to NCM and our partnership with them. Thanks to all of you for joining us for Drive-In Live. To replay or share today's episode, visit our new research and reports portal at thepresidiogroup.com, where you'll find today's Drive-In Live, our latest NCM benchmark data, M&A market updates, dealer surveys, and more, all in one place. Thanks for being with us. We'll see you next time on Drive-In Live.